Have you ever wondered about the difference between ETFs and individual stocks? It's a question that has certainly crossed the minds of many, especially those just starting in their trading journey. Today we're going to delve into this very topic. We'll explore the unique characteristics of both ETFs and individual stocks and highlight the key differences between the two. So, buckle up as we dive into the world of ETFs and individual stocks. This is your chance to level up your investment knowledge. First things first, let's understand what an ETF actually is. An ETF, or exchange-traded fund, is a unique blend of different investment worlds. It's a type of investment fund that brings together the best of both mutual funds and individual stocks. So, how does an ETF work? Well, it's quite simple, really. Think of an ETF as a basket. But instead of apples or oranges, this basket is filled with a variety of investments. These could be stocks, commodities, bonds, or a mix of all these. This basket or fund is then traded on stock exchanges, much like individual stocks. The price of the ETF fluctuates throughout the trading day as the ETF is bought and sold, just like any other listed security. Now, the contents of this basket aren't randomly chosen. They're typically designed to track the performance of a specific index, sector, commodity, or asset class. This could be something broad like the S&P 500 index, or something more specific, like the healthcare sector or gold. By offering a bundle of different investments, ETFs provide a level of diversification that is otherwise difficult to achieve for individual investors. Instead of putting all your eggs in one basket by investing in a single stock, with an ETF, you're spreading your risk across a variety of investments. But remember, while diversification can help spread risk, it doesn't guarantee profits or protect against loss. The performance of an ETF is tied to the performance of the investments it holds. So if the value of those investments goes down, so too will the value of the ETF. It's also worth noting that most ETFs are passively managed. This means they aim to mirror the performance of the index or asset they're tracking, rather than trying to outperform it. This is different from actively managed funds, where fund managers make specific investment decisions with the goal of beating the market. In simple terms, think of an ETF as a basket full of different investments. Now that we understand ETFs, let's move on to individual stocks. Imagine walking into a market with a sea of products. Individual stocks are like single items in that market. When you decide to purchase an individual stock, you're opting to buy a piece of a specific company, making you a shareholder. This implies that you now have a claim on part of the company's assets and earnings. Picture it this way. You're at a pie shop. Buying an individual stock is like buying a slice of the pie, and that slice represents a fraction of the whole pie. The pie, in this case, symbolizes the company. The more slices you have, the larger your stake in the company. By becoming a shareholder, you are essentially becoming part owner of that company, albeit on a very small scale. This ownership stake gives you certain rights, like the ability to vote on the company's board of directors and other important decisions. However, it's important to remember that when you're buying individual stocks, you're putting all your eggs in one, or maybe a few baskets. The performance of your investment is tied directly to the performance of the companies you've invested in. If the company does well, your stocks could increase in value, and you may receive dividends, which are a portion of the company's profits distributed to shareholders. On the other hand, if the company doesn't fare so well, the value of your stocks could plummet. This is what makes investing in individual stocks riskier compared to ETFs. To sum up, buying individual stocks means you're choosing to invest in specific companies. You're betting on these companies to grow and succeed. It's like picking and choosing specific items in the market, based on your research, your beliefs, and sometimes even your gut feelings. So, buying individual stocks is like picking and choosing specific items instead of buying the whole basket. Now, let's delve into their key differences. The first set of key differences we'll discuss revolve around two crucial aspects: diversification and risk. Exchange-traded funds, or ETFs as they're commonly referred to, are essentially a basket of securities. They bundle together a collection of various stocks, bonds, or commodities. This is where the concept of diversification comes into play. By investing in an ETF, you're not putting your money into a single entity, but rather you're spreading it across a multitude of stocks or other financial instruments. This diversification helps mitigate risk, as the performance of your investment isn't tied to the success or failure of a single entity. For example, if one company within the ETF performs poorly, the impact on your overall investment is cushioned by the performance of the other companies within the fund. It's like having a safety net, reducing the potential for significant losses. On the other hand, investing in individual stocks is a different ballgame altogether. It involves putting your money into a single company. Your investment's performance is directly tied to how that particular company fares in the market. If the company does well, your investment grows. But if the company doesn't perform well, your investment takes a hit. In essence, individual stocks can be a bit of a gamble. They offer the potential for significant returns if the company you've invested in does well. But they also carry a higher level of risk, as the fate of your investment is tied to the performance of a single company. To sum it up, ETFs offer a level of diversification that helps cushion the impact of poor performance by any single entity within the fund. This helps mitigate the level of risk involved. Individual stocks, on the other hand, can be riskier as your investment depends entirely on the performance of a single company. Remember, with ETFs, you're spreading the risk, but with individual stocks, all your eggs are in one basket. Continuing with the differences, let's discuss control and costs. Now, when it comes to control over your portfolio, individual stocks may offer a bit more. Picture this: you're the captain of your own ship, deciding which stocks to buy, when to buy them, and when to sell. That's the level of control you get with individual stocks. You can tailor your portfolio based on your specific preferences, risk tolerance, and financial goals. However, this level of control also comes with its own set of challenges. You need to constantly monitor the market, research companies, and make informed decisions about your investments. This can be time-consuming and requires a certain level of expertise in the stock market. On the other hand, ETFs are managed by professionals. These financial experts have the knowledge, experience, and resources to make informed decisions about which securities to include in the ETF. This means, with ETFs, you're essentially outsourcing the decision-making process to professionals. You can sit back, relax, and let the experts do the hard work. Now, let's pivot to costs. Generally speaking, ETFs have lower costs than individual stocks. This is because when you buy an ETF, you're buying a basket of different securities in one go, which reduces transaction costs. Conversely, if you were to buy these securities individually, the transaction costs would likely be higher. In addition, ETFs often have lower expense ratios than individual stocks. An expense ratio is a fee that covers the fund's operational expenses, such as management and administrative costs. Because ETFs are passively managed, these costs are typically lower than those of individual stocks, which are actively managed. So it's a trade-off between control and cost. You decide what suits you best. Do you prefer to have more control over your investments, even if it means potentially higher costs and more time spent on research and decision-making? Or would you rather leave the decision-making to professionals and potentially save on costs? The choice is yours. Let's recap what we've learned today. We started our journey with a big question: ETFs or individual stocks? To answer that, we first had to define what both of these terms mean. ETFs, or exchange-traded funds, are like baskets of securities that give you exposure to a broad segment of the market, while individual stocks represent a single company. We then moved on to explore the key differences between ETFs and individual stocks. We discovered that ETFs offer diversification, which can protect against the volatility of a single stock. On the other hand, individual stocks can provide potentially higher returns if you pick the right one. But remember, higher potential returns often come with higher risk, which brings us to the crux of the matter. Your choice between ETFs and individual stocks should depend on your financial goals and your tolerance for risk. If you are looking for a safer, more diversified investment, ETFs could be the way to go. If you are willing to take on more risk for potentially higher returns, and you have the time and knowledge to research individual companies, then individual stocks could be your choice. Remember, there's no one-size-fits-all approach in investing. It's all about what fits your investment goals and risk tolerance.